The market is panicking, and that might be the best news for your portfolio. In this video, I'm going to show you 5 world-class companies that are on sale right now. I'll also give you the 3 best books to start your investing journey, even if you know nothing about finance. Many investors are selling these stocks for what I believe are the wrong reasons. They're focused on short-term noise, ignoring the powerful growth engines underneath. Stay with me to find out why. But before we dive into specific companies, we need to build a solid foundation. You can't invest confidently without understanding the basics. That's why I always recommend starting with these 3 books. First, Personal Finance 101. This book is your base. It covers everything from saving and budgeting to managing debt and understanding taxes. It's the groundwork for everything else. Once you have your personal finances in order, pick up Investing 1. This is a fantastic introduction to the world of investments. It clearly explains stocks, bonds, funds, ETFs, and even real estate without overwhelming you. Finally, for those who want to go deeper into the stock market, Stock Market 101 is perfect. It's the most advanced of the 3, but still incredibly accessible, focusing on how the market works, how to analyze stocks, and what indexes are. These 3 books give you a complete education from zero to confident. They are all easy to read and designed for a general audience. Building this knowledge is your first big win. If you're ready to build your financial future, take a second to subscribe to the channel so you don't miss any analysis. Now, let's get to the main event, the opportunities. The market is generally expensive, but fear is creating discounts on some incredible businesses. We're looking for leading companies facing temporary problems. First up, Jump China, the exclusive operator of KFC and Pizza Hut in China. The stock is getting hammered because of panic over the Chinese economy and the real estate crisis. But here's the thing, the market is being myopic. People don't buy houses at KFC, they buy fried chicken. Jump China's business has little to do with the real estate bubble. Meanwhile, the company is an expansion machine, planning to open thousands of new stores with a capital return of just 2 years per restaurant. The market is ignoring this incredible growth engine. Next, we have KVUE, the recent spinoff from Johnson & Johnson. This company owns powerhouse brands you know, like Tylenol, Listerine, and Neutrogena. The stock has fallen hard due to legal risks surrounding Tylenol lawsuits. The fear is that paracetamol use during pregnancy could be linked to autism. I believe this is a one-time issue the market is overreacting to. Google it yourself. Major health organizations still consider paracetamol generally safe when used correctly, and studies have not found a conclusive causal link. Because of this fear, KVUE is trading at a significant discount compared to its peers. It's a classic case of buying when there's blood in the streets. This next company is a bit different. It's not facing a lawsuit, but a massive investment that's scaring Wall Street. Later, I'll ask you which type of business you prefer. Let's talk about Constellation Brands, the company that brings us Modelo and Corona beer in the United States. The stock is down because overall alcohol consumption has dipped slightly, and more importantly, they are spending billions to build a massive new brewery in Mexico. The market hates this huge expense, but I see it as a brilliant strategic move. They are building the capacity to secure the supply and fuel the growth of the Modelo brand for the next decade. They aren't waiting for demand, they are building for it. So this brings me to a question. What kind of business do you prefer? One like Constellation that invests heavily to build for future demand, or one that has to wait for demand to recover, like our next company, Danaher. Danaher is a scientific technology monopoly. They make essential tools for scientific research and diagnostics. The stock fell because of a post-pandemic demand shock. Sales of COVID-related equipment disappeared, leaving them with a ton of inventory. But this is a temporary problem. The core business is incredibly resilient. Scientific research doesn't stop for a recession. Danaher generates so much cash that it's constantly acquiring smaller, high-growth companies in cutting-edge fields like gene therapy, strengthening its monopoly. Our final company is Coloplast, a global leader in medical devices for ostomy and continence care. Its stock has been cut in half. Why? European reimbursement cuts and a drop in free cash flow. Free cash flow is simply the cash a company generates after paying for its operations and investments. A drop sounds bad, right? But you have to ask why it's dropping. It's dropping because Coloplast is investing massively in acquisitions and new automated plants. These investments are designed to expand their profit margin significantly in the coming years. This isn't a sign of a struggling business, it's a sign of a business investing for the future. A 50% drop for this seems like a massive overreaction. So, there you have it, 3 foundational books and 5 world-class companies facing temporary headwinds. The key is to look past the scary headlines and analyze the business itself. Remember, market panic is often a friend to the long-term investor. Now I want to hear from you. Have you bought any of these companies? What other beaten-down stocks are on your radar? Let me know in the comments. And if you got value from this video, make sure you're subscribed for more deep dives like this one.